Welcome, accounting boffins. You with Ashraf Patel and the crew. Remember, guys, we're doing income statement, revision of the income statement with adjustments and the fixed asset note. Okay, so if we look at this here, remember what we said? When dealing with the income statement, take into consideration your pre-adjustment trial balance, right? Then obviously you have your adjustments, and obviously this would result in you doing calculations in order to prepare your financial year end, which would be your statements, and also not forgetting that you could have final accounts in the form of your profit and loss and trading account. Okay, what do we have here? You are provided with information from the books of global trading. The financial year ends on the 31st of December 2020. Very important when it comes to your financial year to remember what's the period under review. What are you working from? So in that way you'll be able to identify your accruals, your prepayments, etc. Okay. The first one says, refer to the additional information to calculate the missing figures A to C on the incomplete fixed asset note. Here we go. There's our fixed asset note. Clearly you can see there are certain items that you need to calculate. That's A, that's B, and that's C. Let's start with A right away. We're dealing with the vehicle, right? And in terms of my information, what do I have? Let's see what I've got here. Because there was no disposal at carrying value, which was in fact a 0, you can clearly see that you can make a straightforward comparison with your cost at the beginning of the year and your cost at the end of the year. So here we go. My cost at the end of the year was 780,000. My cost at the beginning of the year was 600,000. So clearly, this means that we purchased assets to the value of 180,000 Rand. Now, be careful about this here. What must you take into consideration? When you're making your comparison with the beginning of the year and the end of the year, if there was no disposal, then it's a straightforward comparison, like we've just done with this particular activity that you've seen here. However, when there's a disposal involved, you cannot just compare the opening balance with the closing balance. Okay? Done and dusted. So there we go. There's our additions at cost, which is 180,000. We now move on to the next one, and we are told that depreciation must be written off on equipment at 15% per annum using the diminishing balance method. Now, what do we understand by the diminishing balance method? By that we understand that we're calculating depreciation on the carrying value. In other words, your cost price minus your accumulated depreciation will give you your carrying value. That's the method of depreciation that we are using. Okay, then it tells us that equipment with a cost price of 18,000 Rand and a carrying value of 12,000 Rand when on the first day of the financial year, right? So in other words, you are given the accumulated depreciation at the beginning of the year. Very important. Remember what we said, your dates are very, very important. Which dates? We love the dates that we eat and obviously the other dates that we have in our lives, but here we're talking about the accounting dates. Take that into consideration when you are doing your calculations. Right. So, and this was sold to a partner, Tim Lowe, on the 30th of September, another important date. No entry has been made for any of the above transactions. Right, let's get into it. So step number 1, your depreciation on equipment at the date of sale. Your carrying value, they told you, was 12,000 Rand. Therefore, 12,000 Rand as your A. Remember, we always use art. What do we mean by art? The amount, the rate of depreciation, and the time component. That will always be something over 12 because we're working with our financial year. Okay, so there we go. 12,000 Rand was the amount because they told me my carrying value at the beginning of the year was 12,000 times my rate, which is 15%, times 9 divided by 12. Why? When was this equipment sold? It was sold during the financial year, and therefore for this year it was used for 9 months. If you do this calculation, you're going to get a figure of 1,350. Let's do the calculation so you can clearly see it. Here we go. So it's 12,000 times your 15% times 9 divided by 12, and that gives you a figure of, okay, because I didn't use a percentage, obviously divide by 100 to do the percentage, and there we go, 1,350. That is my depreciation on what? On my sold equipment. Very important. Okay, we now go ahead and say, fine. In my table, one of the items that I have here is my depreciation, but remember that 1,350 is only part of the depreciation. It's only the depreciation on the sold equipment. Remember, there are 3 components that you look for with depreciation. What are they? It's your sold, your unsold, and your new. Got it? Brilliant. Let's move on. So then they're telling you, okay, we've done that information, we've got that information, here we go. In terms of the disposal, watch, the cost price was 18,000, right? The carrying value at the beginning of the year was 12,000. We calculated our depreciation for the current year to be 1,350. Now, what I want to do for you now is take you into your table. Remember what we said. Whenever you are doing an asset disposal, always draw up a table for yourselves. What do we have in this table? Let's look at it. 1, the depreciation we've calculated was the 1,350. The cost price was 18,000, right? Now remember, the accumulated depreciation was 6,000. Now you must be asking the question, where does the 6,000 come from? Very simple. Your carrying value was 12. Cost price minus accumulated depreciation gives you carrying value. So obviously, if your cost price was 18 and you had a carrying value of 12,000, your accumulated had to be 6,000 Rand. Okay, so that's the 6,000 Rand plus this year's depreciation to give me a total accumulated of 7,350. Next step, work out your carrying value. How do we do that? We say take the 18,000, which was my cost price, minus my accumulated depreciation of 7,350 to give me a carrying value of 10,650. That's the figure we're looking for. Remember here, what did we want? We wanted the carrying value of the asset that we are disposing. Now, once again, what am I explaining to you? The purpose of that table gives you the carrying value in your calculation. And yes, you're going to need it for note number 3, because note number 3 says disposals at carrying value. Got it? Okay. Then we got the last one to calculate, and that was the depreciation on the remainder of the equipment. Let's have a look at it. So, because we are using the diminishing balance method, remember, it's 2 brackets. What do I mean by the 2 brackets? It's your cost price bracket and your accumulated depreciation bracket. So let's do the cost price bracket first. Here we go. The cost price of my equipment at the beginning of the year was 280,000. So therefore, I say 280,000 minus the 18,000. What is the 18,000 that I'm subtracting? That's the cost price of the equipment that was disposed. Got it? Brilliant. Second bracket. So that gave you the 262,000, which was your cost price of the old equipment. Now we go to the second bracket and we say accumulated depreciation on the old unsold. Start off with my opening balance. Let me find my opening balance. Here we go, 70,000 Rand, opening balance. And then minus the 6,000. Now this is the critical part. Which figure do I subtract in my accumulated depreciation? I'm going to take you back to the table. Can you see this 6,000 Rand here is your beginning of the year balance, right? So therefore, when you are doing your calculation, very important, it is always the beginning of the year balance that you subtract. Got it? I repeat, you subtract the accumulated depreciation at the beginning of the year. Right. Very often we find candidates bringing in the 1350 as well. Now remember, the 1350 is not part of the 70,000 because the 1350 we processed this year. So always when you are doing this calculation for the accumulated depreciation, remember it's the opening balance of the accumulated depreciation. Got that? Brilliant. So we got the 70,000 minus the 6,000 to give me a figure of 64,000 Rand. Okay, so that is now the accumulated depreciation of the old unsold equipment. Clear? Have I got my two brackets? Let me check. So we say fine. The cost price is 262,000. There's my 262,000, which is my cost price, minus my accumulated depreciation at the beginning of the year. So let's just indicate, there's my cost price, there's my accumulated depreciation, and voila, there's the figure that I'm looking for, my carrying value. Okay, so a recap on what I've done. Number one, take your cost price, subtract the asset that you are disposing of. In this case, we had the figure of 280,000 minus the 18,000. So cost price bracket, done and dusted. Number two, look at your accumulated depreciation. Take your opening balance, which we did, 70,000 minus the accumulated depreciation. What do we look out for here? It's your figure at the beginning of the financial year. Therefore, 70 minus the 6 to give me 64,000. What do I now do? Cost price minus the accumulated depreciation will give me my carrying value at the end of the year of 198,000 Rand. So I've got the carrying value that I now require in order to calculate what? My depreciation on my old unsold equipment. Okay, here we go. So there we have the figure, 198,000, which is my A. Got that? There's my R, my rate of depreciation, and there's my time component. I've always mentioned this and I'm repeating it. Although it may be 12 over 12, get into the habit of using the time component in your calculation because you never know when is it going to be less than 12 months. So here we do that. Let's do the calculation there. There we go. 198,000 times my 15%, okay, will give me that, times 12 divided by 12. Obviously, that's 1. We know the answer. So here we go. 29,700. What is the 29,700? That's the depreciation on my old unsold equipment. Right. Remember I told you, you need the total figure for your depreciation figure in your note number 3. Therefore, watch. Your sold equipment, 1350, we calculated. Your unsold at the end of the year was the 29,700. Therefore, add the two components together, and that then gives you your total accumulated depreciation of 31,050. Let's look at what it looks like. Here we go. Can you see? Now, good practice, good accounting practice for you, for the exams, for your assessments, when you're working by yourself, show this depreciation in brackets. The 1350, was it 1350? Let's just verify the amount. Yes, it was. 1350 plus the 29,700. Let's just verify. 29,700, there we go, plus the 29,000 700, you'll see the total is your 31,050. So what are you doing? You're showing the breakup of the depreciation. Perchance, if you make an error with one, you can still get a part mark for the other. Okay, so now let's look at our completed note. What do we have? We've worked out our additions at cost. Remember what we said? Straightforward comparison with the beginning of the year and the end of the year. And the reason we could do that was because there was no disposal. Number two, we calculated B, the disposal, that carrying value. Here I refer you to the table. Remember, in your table, you did the calculation, and therefore you can actually use that calculation from your table. And then C, obviously, was the depreciation, which we just concluded. We said, show all the depreciation. In this case, there was no new, but there was sold as well as unsold. Okay, guys, I'm sure you are now in a situation where the moment you see an asset disposal and a note number 3, you must be itching and saying, this is the one I want to answer because I understand it. You want to know more? Stay with us. See you just now. Welcome back, Accounting Boffins. You're with Ashraf Patel. We're doing income statement, also known as the statement of comprehensive income. We're relating it to our adjustments. Right, let's get right into it and see what do we have here. Right, we have information relating to global trading, right? And we know that we're completing the adjustments, so here we go. That's an extract of my pre-adjustment trial balance. Remember, this would be obviously my balance sheet account section, and this would be my nominal account section. So clearly you can see that when I'm doing my statement of comprehensive income, I need my nominal account section. Obviously, there may be information in the balance sheet account section as well, depending on the information. Okay, the first adjustment says, a credit note was issued on the 31st of December for 9920. Goods were sold with a markup of 60%. No entry has been made of this transaction. Right, so simply it means that there was a transaction where a debtor returned goods to us. Okay, now two things to take note of here. One, when there's a physical return of goods, as is the case in this particular transaction, then you have to do two entries. One with the selling price and the other with the cost price. However, when there's just an allowance granted to a debtor, then you only do one transaction, and that's with the allowance, which obviously would affect your debtor's control and the debtor's allowances. So keep in mind that when there's a physical return of goods, there's always two entries that we need to process. So in this case here, there was a physical return of goods. So what are we going to do? Two entries. Let's look at the two entries here. Firstly, the selling price is 9920. So obviously, what's the entry for the selling price? Will always be a debit to debtor's allowances and a credit to debtor's control. Think about it rationally. The debtor owes you less. Credit the debtor's control. Debit your debtor's allowances, which we will subtract from our sales figure. Right, but we were not given the cost price. We had to calculate the cost price. Not a problem. Don't fear when Ashraf is near. Okay, so what are we going to do? Watch. The markup is 60%. So therefore, keep this in mind. Your cost price is 100, your markup is 60, and your selling price is 160. So obviously you can see, what are we calculating? The cost price, so multiplied by 100 divided by 160. There's my calculation. And if I do that calculation, let's do the calculation. So here we go, 9920 times 100 divided by 160, and voila, we have our cost price of 6,200. Okay, so this we've now calculated the cost price of the goods that were returned. How does this impact on my statement of comprehensive income? Watch. Here's my sales figure of 3,345 and my cost of sales figure of 2,090,625. Sales figure once again 3,345,000. Okay, so there we go. 3,345,000 as my starting point. Where do I get that from? From my given information. And I subtract the selling price of the goods that were returned, and obviously this will give me now a figure of 3,335,080. Watch the cost price, which I calculated. Remember, 6,200. You remember my calculation? Here it is. And what do I do with it? What's the entry for my cost price? Look at the accounting entry, which will then make sense to you. It's a debit to trading stock, the goods coming back into our business, and a credit to my cost of sales. Therefore, my operation in my bracket is critical. I'm crediting my cost of sales, meaning I'm subtracting from my cost of sales. There we go. So 2,090,625 from where? From my given information, and obviously minus the cost price of the goods that were returned to give me 2,084,425. Sales less my cost of sales will give me my gross profit of 1,250,655. That's the first part of my statement of comprehensive income done and dusted. What is it? Sales less the cost of sales. Got it? Brilliant. Let's move on. Rent was received up to January 2021. Take note, the rent was increased by 12% on the 1st of August 2020. Right, this is when the percentage increase in rental is given to you. Let's watch how we go about doing this calculation. Very important. Once you master it, piece of cake, chocolate cake, so you know what's our favorite. Okay, here we go. My rent income figure is 126,224. Remember, that figure includes January, which I now need to remove. Okay? But the rental was not constant throughout the year. There was a change in my rental, as a result of which I now do the following calculation. Here goes. Let your old rental be 100%, right? Your new rental will be 112. Why 112? 100 plus the 12% increase. Now ascertain, for how many months was the rental at the old rental? Remember, the rental only increased. When did the rent increase? Let's just check this out. The rent was received up to January. The rent was increased in August. So obviously, it means that from January to July, which is 7 months, your rental, therefore the 7 guys, times the 100%, which was the old rental, to give me a figure of 700, right? That's the old rental. Let's take the new into consideration. The new was for 6 months. Why 6 months? Watch, August, September, October, November, December, and January. Why am I including January? Because I've received the rental including January, and that's the challenge. I need to determine the January rental to be able to do my adjustment. Therefore, watch this here. It's 6 times 112 to give you 672. Now watch what I do. 700 plus 672. Add the 2 percentages, and that will then give you the 1372. Now you know where the 1372 comes from. It's the total in terms of the old plus the new. Got it? Okay, now what do? I now draw up my equation. What's my equation? 1372 is equal to 126,224. From where? From the rent income figure given to me in my pre-adjustment trial balance. And what am I looking for? Always ask yourself, what am I looking for? I'm looking for the January rental. Now, what was the January rental? The January rental, was it 100 Definitely not. What was it? It was the 112 because it was part of the new, the increased rental. Okay? Therefore, 112 is equal to my unknown, cross multiply. Let's do that. We say 1372. Let's take it the other way. Let's say 126224 times, remember, cross multiply. So let's go back to our calculator. 126224 times the, let's go back there. Here we go. 126224 times the 112 divided by 1372, and here we go. There's my figure, 10304. What is the 10304? That will be the rental for January. Now you ask the next question. Was this an accrued income or a deferred income? Remember, deferred income, also known as income received in advance. Clearly, this was a deferred income. Operation tells me minus. Why? It's a debit to rent income and a credit to deferred income. Remember, deferred income will go to your balance sheet under trade and other payables because it's a temporary liability. So therefore, watch my operation. Here we go. 126,224 given figure minus, that's the important operation. Minus, why? Debit the rent income. Let me just explain this a little bit further for you. Here's my rent income, right? It's an income account with a credit of 126,224. Watch, I'm subtracting, meaning I'm debiting rent income with 10,304, and therefore this, in accounting, when you do on the opposite side, you are actually subtracting. Therefore, 126,224 minus the 10,304 will give me my rent income figure that I need for my statement of comprehensive income. Got it? Okay, next adjustment. Consumable goods used during the year amounts to 54,368. Remember this acronym here? RTFQ. Read the full question. Right. Why? Because they're clearly telling you in this adjustment, your consumable goods used, not what was left over. And therefore, the adjustment changes. So therefore, this is what we do. If that's the amount that we used, clearly you can see here, here's your consumable goods that you bought, 62,540, but the amount that you used, the moment that figure is given to you, that becomes the final figure for your income statement. Obviously, the difference between what you had purchased, which was, where's the figure, 62,540, the 62,540 minus the 54,368. Let's get that figure here. Here we go, 62,540 minus 54,368. Obviously, the 8172. What is the 8172? That is your consumable stores on hand left over. That will go to your balance sheet under inventories. Okay, next one. Bad debts, a further amount of 8,360 must be written off. The provision for bad debts must be adjusted to 10,480. Okay, what does this mean? Firstly, do the bad debts. Double entry, debit bad debts, credit debtors control. Let's do that. So there's my bad debts figure, 9450. Here you can see, there's my 9450, plus the further bad debt of 836 gives me 8360, gives me a total of 17,810. So my bad debts is 17,810. Remember, we said good practice, but because we've done it here, we're just saying that take that amount there and show it in your brackets as part of your calculation. Okay, now we come to the provision for bad debts, which said must be adjusted to 10,480. Before we continue, what type of an account is provision for bad debts? Provision for bad debts is what we refer to as a negative asset. Why? It reduces the value of my asset. Which asset? Debtors control. Therefore, in my balance sheet, we say debtors control less provision for bad debts. And this then tells you your net trade debtors. Okay, so in terms of the provision, I currently have a provision of 13,050. So therefore, I know now that I must reduce that provision by 2,570. Why? 13,050 minus my new provision of 10,480, and here you can see it, provision for bad debts, because it is being reduced, indicates that it will appear under my operating income. Keep that in mind. When you're increasing your provision, it's an expense. When you're decreasing your provision, it's an income. As you can clearly see, we decreased our provision, and therefore it is now an income. The adjustment is an income of 2,570. Okay, next adjustment. Interest on the fixed deposit was earned at 8% per year. Take into account that the fixed deposit was increased by 30,000 on the 1st of September. This transaction was recorded. Okay, here we go. So there's my fixed deposit. Let me identify it. Where it is, there's it, 55,000. So therefore, when I'm doing my calculation, remember, 55,000 is the new amount minus the amount that we increased it during the year to give me my old of 25,000. So therefore, if we work out our interest on the initial investment, it's your 25,000 times the 8 divided by 100 times 12 divided by 12. That's for the whole year. The interest earned on the new investment will be 30,000 times the 8%, which is 8 over 100, 8 divided by 100 times 4, because it was only for 4 months, to give me a total of 800 Rand. So your total interest should be 2,800. Watch what you do here. Separate the old from the new. Find your initial fixed deposit, work it out for the year. Then work out your fixed deposit on the new investment, add the two together to give you your total interest that you require. Therefore, look at my interest income. If I look at the figure that I'm given here, interest on fixed deposit is the 2,200. So remember, this total amount that you require here is the 2,800. So that was my calculation of my interest. The 2,200 was the figure given to me, plus 600 will give me my 2,800. Okay, the last one that we have here, last one that is just before the break, let's just go through it very quickly. We are told here that insurance included a policy with a yearly premium of 9,900. It was paid on the 1st of August 2020 and expires in July. How do we deal with it? Firstly, find your insurance figure of 26,500. Here we go. But remember, this is one policy that we must remove. We're working with a one policy that has a prepayment in it. Therefore, you find that the total amount that we paid was 9,900. It was paid on the 1st of August. How many months were for the next financial year? 7 months. So what do? We take the 9,900, divide it by 12, and then multiply it by 7, and the 5,775 will be the amount that we've prepaid on the insurance. Therefore, this is what we're going to do. Watch. There's my insurance figure, 26,500. From where? From my given information, 26,500. There we go. Minus the prepayment. Why? Because what's my double entry? My double entry is a debit to prepaid expenses and a credit to insurance. Once again, look at your insurance account to make it much more clearer for you. There's your insurance with 26,500, right? Remove the 5,775 to give you a figure of 2725. What's my double entry? Debit prepaid expenses with 5,775 and a credit to insurance, indicating that you must subtract in the brackets. Okay, guys, that's as far as it goes in terms of your calculations. Remember, we're doing more adjustments. You want to know more? Stay with us. See you in a jiffy. Welcome back, accounting boffins. Yes, you can actually feel the vibe in the lesson because we're doing adjustments which are critical for your understanding of your financial statements. Once you master the adjustments, you will enjoy doing the financial statements. Right, let's go right into the adjustment, which says here, the business sells plastic bags to its customers at 50 cents each. The profit or loss on sale of plastic bags reflects the following. 1. Cost of plastic bags that we purchased, 51,200. Cash received from the sale of plastic bags, 56,600. Now, we are also told, and I think the examiners were quite kind in this one here, telling you that the reversal of the stock on hand at the beginning of the year was 5,700. Now remember what we said. Whenever you are dealing with any adjustment, the first thing that you do is go and check in your balance sheet account section if any of the big 5 appear. What am I referring to? Accrued income, deferred income, prepaid expenses, accrued expenses, and consumable stores on hand. Right. In this case here, they told you the reversal had to be taken into consideration. But look at it here. You can see here, stock on hand of plastic bags. There we go, 5,700. So even if you were not told about it, this is something that you have to pick up from yourself, that there should have not been a reversal in my balance sheet account section. Therefore, I now have to do the reversal, right? What's my reversal? Watch here. So I start off by saying 5,700. What was that? My reversal. So let me mark it with an R so you know what that is. Right. What else do I know? I purchased, where we go, I bought goods, or the bags bought on credit was 12,800. So therefore, watch my calculation. There's my plus 12,800. Let's mark that as the credit plastic bags that we bought, right? What else do we know? We know that we purchased on cash 51,200. Therefore, there's my 51,200. That will be my cash purchases of my plastic bags. And what else am I told with regards to my plastic bags? Let's see what we have here. I'm told that, here's it, the cash received from the sale of plastic bags was 56,600. Therefore, in my calculation, minus 56,600. I'm going to explain that just now. Let me show you what we're doing here. Obviously, what you're doing here is a trading account for your plastic bags. So you start off with the 5,700, which was your reversal. Then you bought for cash 51,200. You bought on credit 12,800. You sold for 56,600. And there was something else we were told. We were told the stock on hand at the end of the year was 3,600. Therefore, 3,600. Watch. I want you to relate the account with the calculation. Watch. 5,700. You're adding 51,200. You're adding the 12,800. Why? All on the same side. Minus the 56,600 because it's on the opposite side of your account, minus your closing stock, which is on the opposite side. And you will notice here that you have a loss of 9,500, meaning you're crediting this account with 9,500, and obviously you're going to debit a loss on sale of plastic bags of 9,500. Now, what has this adjustment done? This adjustment is testing your knowledge of the periodic inventory system. Can you see? how the examiners are testing your knowledge of the periodic inventory system in adjustments, but relating it to the plastic bags that the business sells to its customers. So once again, opening stock plus purchases, look for returns, less your closing stock, less your sales. There we go. There we have our loss on sale, and this then gives us our loss on our plastic bags. Right, we move on now to the next adjustment, which is salaries and wages. Okay, what are we told? One employee was omitted from the salaries journal for December 2020. The salary details are as follows. Net salary was 46,000, employer contributions was 9,800, and the deductions was 14,500. Now, what do we know from salaries? Net salary plus deductions gives me my gross salary. Okay, I repeat, net salary plus deductions gives me my gross salary. Stated in other words, gross salary minus deductions gives me net salary. Okay, so what figure am I looking for? I'm looking for my gross salary, the total salary that was due to my employee. So what is it? It's the net salary plus my deductions. Watch. So what do we do here? We take our figure here, which is 46,000, right? Plus the 14,500, and that will give you a figure of 60,500. So therefore, you take your salaries and wages of 175,000 as your starting point. There's your 175,000. Add your net salary plus your deductions. So in other words, that is your gross salary, right? Okay, now, very often you find some businesses including the employer's contribution as part of salaries and wages, like I've done here. Okay, what have I done? This is a standalone expense, namely the employer's contribution. What is this here? These are the perks that we give to our employees. Yes, it's an expense to the business. Therefore, employer's contribution is an expense. Understand that. Sometimes it is shown as part and parcel of salaries and wages, and sometimes it is shown as a separate amount. I'm going to show you both methods here. Watch. In this case here, it's added as part of salaries and wages, but you could have a situation where you are told, show your employer's contribution as a separate item. Therefore, you would have employer's contributions as a standalone 9,800. Okay, now remember, these are two separate scenarios, and I'm going to explain them both to you as we go along. The first one is the one that the question asked for, where the employer's contribution was part of my salaries and wages. As you can see, there's the 9,800 included in salaries and wages, therefore giving you a figure of 245,300. However, if you had a situation where the employer's contribution was a standalone expense, it happens in some questions. You'll see employer's contributions as a standalone expense. In that case, you would then add the 9,800 to your employer's contribution. The effect is the same, but sometimes for reporting purposes, and this is important for us in accounting, sometimes a business wants to know what are my expenses in relation to my employee benefits. Then obviously they'd keep a separate account called employer's contribution. Whereas if it's part of salaries and wages, it's difficult to find it, to find the actual amount. What was my employer's contribution? As you can see, the total expense is 245,300, but the employer's contribution is only the 9,800. Okay, so therefore, depending on the needs of the business, they would then decide. Okay, this was a bit of an ethics question, which says here, Take note that equipment with a cost price of 18,000 and a carrying value of 12,000 on the first day. Remember, we've done this one here, right? And we had another partner, Joe Matibi, who has complained that Tim Lowe has acted unethically in taking over the computer for 4,000 Rand. Tim disagrees. Right. So obviously we have a scenario here now where the one partner is saying you shouldn't have done it, and the other partners agree. It says no, it was fine, no problem. It was hunky-dory. Let's look at what our responses are. Our question says, give one opinion to support Joe and give one opinion to support Tim. Here we go. Let's start with Joe first. Tim is benefiting from a very low charge on an asset that is worth a lot more to the company, and hence the partners are losing as a result of this transaction. A large loss was made on this disposal. So therefore, you can see what we are saying, that I showed you that the carrying value was in the region of 10,000 Rand, and it was taken over at 4,000 Rand, if memory serves me correct. So obviously, there are also tax implications. There are also tax implications for this year, as the partner should be paying tax on this perk. The transaction was not transparent. No discussion or disclosure on the disposal in advance. The asset was still of use to the company, and the partner had no right to take it. So all these answers that we are giving are in support of Joe. However, there's also another opinion, and let's look at that one. The computer is already more than 3 years old, right? And it has a relatively short lifespan. That's true. Think about it. Although you may be using your computers for a longer period, but generally your lifespan of your computer is 3 years. Why is it 3 years? As a general question, generally you find with technological advances, within 3 years, the computer becomes outdated, right? So therefore, general lifespan, 3 years. Okay, the computer is outdated, as I mentioned. It will probably not be upgradable. That means you can't upgrade it because obviously now there's new technology on the market. The depreciation at 15% on carrying value for computers is unrealistic and should therefore have had a lower carrying value. Definitely true. So obviously, if you wanted your computer to last for 3 years, in our records, we should have been writing of depreciation at plus minus 33.33% per annum. So therefore, if you do that and you write off over a period of 3 years, at the end of 3 years, the computer will now be reaching its carrying value of the 1 Rand. And you must remember, we've dealt with the 1 Rand depreciation in our other lessons. Okay guys, so what have we done? We've shown you how you do your adjustments and how you then use the information from your adjustments, showing your calculations on your statement of comprehensive income. Once you've done with that, your statement is completed and you are ready to hand it in and start with the next question. So guys, once again, important, show your calculations, work in such a process that you show all your adjustments. Start off with the figures that are given to you in your statement of comprehensive income. In your bracket, that's your starting figure. Do your operation. Now remember, again, is it a plus, is it a minus, depending on the adjustment. Then have your final figure, and in that way, you're going to ace the income statement. From me, Ashraf Patel, and the team, keep your feet on the ground, reach for the stars, because you definitely are an accounting shining star. Until next time, be good.